Let's revisit SoFi for a bit. It's been a couple of weeks since they reported yet another good quarter. The stock is moving, but not that much, let's be honest, despite it having quite a good track record, right? Sales estimates beat, EPS beat, guidance beat. I mean, this is quite a good track record to have. Of course, with SoFi, we know this is not the whole thing. We know this is a bad stock, but a good company. Over the past 3 years, stock is down 46%. Year to date, it's still down 25%. Has a market cap of $7.8 billion, has a forward PE of 44.1 times. Of course, it's still early days from a profitability standpoint, so just looking right now at the PE, to me, just doesn't make much sense. Now, this video, I just want to go over recent things that came out that I found, plus a couple of things that, of course, happened last quarter, things that we should be focusing on for the coming quarter, especially as we expect rate cuts to happen. What will happen when the Fed will cut rates? Well, we'll discuss that later in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, first up, I want to touch on something that I found on Bank of America's statement. And they say here, Bank of America spends $12 billion annually on technology, of which $3.8 billion will be allocated to new technology initiatives in 2024. Over the last decade, the company has spent $32 billion on new technology initiatives. $32 billion. These ongoing investments, combined with our high-tech, high-touch approach, continue to enhance the client experience across all channels and to drive operational efficiencies across our company. Now, of course, I'm not American, so I don't know, but if you are a client at Bank of America, $32 billion in the last decade on technology. Has your experience been any better? If so, let me know down in the comment section below. But spending $12 billion annually on technology, that is quite something. That's a lot of money. Now, some people were saying on X, oh, is this how they're going to disrupt SoFi and Robinhood? It's the other way around. It's SoFi and the likes of Robinhood that are disrupting the legacy banks, the legacy institutions. The fact that they have to spend $12 billion annually on so-called technology, and yet, from what I've been seeing and hearing, nothing much has changed. Maybe the term technology is interpreted in many, many ways at Bank of America and maybe legacy banks. Maybe it's part of their ATMs, I don't know. But from what I've been hearing from the US subscribers, the experience is not that great. But again, do share your thoughts down in the comment section below. When I read this, I was mind blown. Then more recently, we've had some fund managers, whatever you want to call them. They filed, of course, their 13F, so we know if they're increasing or decreasing their positions in SoFi. Here you have the part of the folks that are increasing, and here you have the parts of folks that have decreased or completely sold out. Then we also found out that SoFi Bank here is now the 69th largest in the United States. The last number we've got was 74, and 1 year ago they were number 90, so making some steady progress. Now, I know, by the way, this is based on assets, so some people will already write, oh, maybe they should do like Robinhood and their deposits will increase. Deposits are a liability for banks, not assets. Moving on to some recap here from Brad Freeman, Stock Market Nerd on X. Extremely good follow. So this was basically SoFi in the last quarter, last year, and 3-year CAGR. I mean, like I said, this is a bad stock, but definitely not a bad company. So eventually the market will realize, oh, actually there is something good behind that ticker symbol. When will that happen? Hopefully sooner rather than later. But it will happen, because putting out these types of numbers, these types of performances will not go unnoticed forever. As for what Anthony Noto told us last earnings call, he was really on fire, especially at the end. So he ended by saying all of this. If you can't tell by now, I feel great. To put it bluntly, I do not know of any financial service company or fintech that has transformed their business to be less risky, less capital intensive, while still driving strong revenue growth, 40% plus user growth, all while massively increasing profitability and still funding a rapid pace of innovation. When you take a step back, It's inspiring to see we hit record revenue of nearly $600 million with 22% year-over-year growth despite lending barely growing. We did that because we achieved record revenue in our financial services segment at $176 million, up 80% year-over-year on the back of 40% year-over-year growth in products, 80% year-over-year growth in deposits, 58% year-over-year growth in assets under management, and 67% year-over-year growth in interchange. In lending, we grew home loan volume 71% year-over-year, student loan refinancing volume 87% year-over-year, and personal loan 12% year-over-year, while delinquencies declined on an absolute and percentage basis for personal loan. And we provided vintage analysis that clearly shows why we are comfortable with personal loan life of loan loss forecasts. And finally, we grew EBITDA 80% year-over-year. And this is basically what you can see from the originations, growing 22% year-over-year. Personal loans increased 12% year-over-year, but 28% quarter-over-quarter. And this is where I want to touch on the aspect of rate cuts. What will happen? Well, on the negative side, of course, rates come down. Net interest income, of course, you'll make less money on that. Of course, with rates coming down, maybe if you're not offering the best rates as a company, it will be highly competitive. But SoFi has said countless times that even when rates will come down, they will still continue to offer a better than other rates, meaning they will be attracting more and more customers because their business model allows them to keep their rates higher than the others. So here I wrote down a couple of things that will happen or could happen when interest rates go down. Increased lending activity. So lower interest rates typically stimulate borrowing. This can lead to increased demand for SoFi's personal loans, student loan refinancing, and other loan products. Improved net interest margin. So while SoFi's loans are primarily fixed rate, a portion of its portfolio is adjustable rate. Lower interest rate could lead to a more favorable net interest margin as the cost of funding decreases. Lower interest rates can make borrowing more affordable, attracting new customers to SoFi's platform. Though SoFi can offer competitive interest rates on deposits, a general decline in market rates could make its offering more attractive, leading to increased deposit growth. And to be honest, I expect all of that to happen. Maybe not directly, but I'm pretty certain that this is their game plan. Moving on to something that was positive in the quarter, Galileo accounts increased 23% year-over-year, so we continue that reacceleration. That's fine. But the technology side of things was below my expectations, grew only 9% year-over-year to reach $95.4 million. Yes, contribution profits is a bit better and all, but we are still not getting that much information from that side. And let's be honest, overall, we are investing in SoFi, of course, because it's not just a bank. It has a bank, but we like the SaaS side of things. Right now, maybe in the coming quarters, things might change, but right now, the technology side of things, we're not really seeing some great signs, at least not for now. We're also not provided with a lot of information, which is a shame. Hopefully, they'll give us more in the coming quarters, but then again, I've been saying that for quite a while. Then they talked a little bit about two new things that will come out this year. One is the credit cards, two new cards that will come out or have come out, but they will invest a bit more in that side of the business. Still very, very small, but they expect it to be quite a big business in the future. Then with regards to SoFi Plus, of course, that's not new, but they said they achieved 1 million members. Now, for SoFi Plus, if you don't know what that is, basically this is the difference between SoFi Plus and regular SoFi. With SoFi Plus, you can get here up to 4.6% API, up to 3.3% cashback rewards on SoFi credit cards, and a couple of extra things. Now, this is only available to those who enable direct deposit. But they said here, they're very excited to share that they've laid the foundation to provide more value in SoFi Plus, not only to direct deposit members, but also a monthly paid subscription product for those who prefer that option over direct deposit. We intend to test this new subscription-based option for SoFi Plus later this year, so this is another revenue stream for them. And now lastly here, a guidance, and this is again why I think they are lowballing it. So for Q3, they expect revenue between 625 and 645, so let's take 635 million at the midpoint. Now if you're taking this number, 635, the number from Q2 and the number from Q1, and then you look at their full year 2024 guidance for revenue that will come between $2.42 and $2.46 billion. This means that they think that in Q4, revenue will come in lower than Q3. Do I think this will happen? No. So yeah, I think they're lowballing it yet again. But as we've seen at the start of this video, they have quite a good track record of beating the expectations, not just their own, the analysts' expectations, and also raising the bar. I expect it to happen as well. So overall, while the stock, let's look at the stock right now for a second. And so the stock, yes, in the last couple of weeks, just like most stocks in the stock market right now, has rebounded nicely. But we're still under $8. Yes, we are now at the 200-day moving average. We're above the 50 and the 20-day one. RSI is pretty neutral here on the weekly, but we're still under $8. We're actually still under $7.50, which has been the price for quite a while, right? Not just in 2024, but if you look at all the way back, April 2022, May 2022, those were times where SoFi was also trading at $7.50. But we know that the business today is already much better business than back then. Okay, could be that back then the stock was just overvalued and now it's very valued. Yeah, you can make that argument. But I think SoFi today should be worth more than what the market gives it. But okay, I've seen this happen with a lot of other stocks as well. We've seen that with Robinhood. It took a while until the market actually noticed, oh, actually, it is quite a good business. And then we went from $8 to $20 quite quickly. Yeah, there were some pullbacks along the way as well. But like I said, eventually the market will notice great businesses behind a struggling ticker. So overall, that's about it for me in this video. I'm still long SoFi, still tend to hold this company for a long time. Very bullish on the business. Yes, it is a bad stock. Yes, it sucks to see the market go up, yet your position in SoFi is not really moving that much. That's why I keep saying bad stock, good company. Short-term issues, long-term, I think there is quite a lot of money to be made here. That's why I have a position. That's my opinion. Do share yours down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.